Talking about IRAs in publication 590, I'm on page 71, the section on additional tax on early distribution. If you receive a distribution that is not a qualified distribution, you may have to pay the 10% additional tax on early distributions as explained in the following paragraphs. Distributions of conversions and certain rollover contributions within 5-year period. If, within the 5-year period, starting with the first day of your tax year in which you convert an amount from a traditional IRA or roll over an amount from a qualified retirement plan to a Roth IRA, you take a distribution from a Roth IRA, you may have to pay the 10% additional tax on early distribution. You generally must pay the 10% additional tax on any amount attributable to the part of the amount converted or rolled over, the conversion or rollover contribution that you had to include an income, the capture amount. A separate 5-year period applies to each conversion and rollover. See ordering rules for distributions later to determine the recapture amount, if any. The 5-year period used to determine whether the 10% early distribution tax applies to a distribution from a conversion or rollover contribution is separately determined for each conversion and rollover, and is not necessarily the same as the 5-year period used for determining whether a distribution is a qualified distribution. See what are qualified distributions earlier. For example, if a calendar year taxpayer makes a conversion contribution on February 25th of 2013 and makes a regular contribution for 2012 on the same date, the 5-year period for the conversion begins January 1, 2013, while the 5-year period for the regular contribution begins January 1, 2012. Unless one of the exceptions listed later applies, you must pay the additional tax on the portion of the distribution attributable to a part of the conversion or rollover contribution that you had to include in income because of the contribution or rollover. You pay the 10% additional tax in the year of the distribution, even if you had included the conversion or rollover contribution in an earlier year. You also must pay the additional tax on any portion of the distribution attributable to earnings on contribution. Other early distributions. Unless one of the exceptions listed below applies, you must pay the 10% additional tax on the taxable part of any distribution that are not qualified distributions. And here's your exceptions. You may have to pay the 10% additional tax in the following situations. You have reached age 50. Okay, you do not have to pay that 10% additional tax. If you have reached the age of 59 and a half, you are totally or permanently disabled, you are the beneficiary of the deceased IRA owner, you use the distribution buy, build, or rebuild your first home, the distributions are part of a series of substantial equal payments, you have unreimbursed medical expenses that are more than 10% or 7.5%, if you or your spouse was born before January 2nd of 1949 and your AGI defined earlier for the year of your AGI for the year, you are paying medical insurance premiums during the period of unemployment. The distributions are not more than the qualified higher education expenses. The distribution is due to an IRS levy or a qualified plan, or the distribution is a profit reserve distribution. Whether the exceptions are discussed earlier in Chapter 1 under early distribution. Good, because they sound like really good. So you have a flow chart to explain the distribution from the Roth IRA of qualified distribution. Now we're in ordering rules for distributions. Page 73. If you receive a distribution from your Roth IRA that is not a qualified distribution, part of it may be taxable. There is a set order in which contributions, including conversion contributions and rollover contributions from qualified retirement plans and earnings, are considered to be distributed from the Roth IRA. For these purposes, disregard the withdrawal of excess contributions and the earnings only. Discussed earlier on what if you contribute too much. Order the distributions as follows. 1. Regular contributions. 2. Conversion and rollover contributions on a first in, first out basis, generally total conversions and rollovers from the earliest first year. The aggregation, grouping, and adding rolls over. take these conversion and rollover contributions into account as follows. A. Taxable portion, the amount required to be included in gross income because of the conversion or rollover first, and then the non-taxable portion. 3 is earnings on contributions, so that's how your distributions should be ordered. Disregard rollover contributions from your Roth IRAs for this purpose. Aggregation, grouping, and adding rules. Determine the taxable amounts distributed, withdrawn, distributions, and contributions by grouping and adding them together. Bullet point 1. Add all distributions from all your Roth IRAs during the year together. Bullet 2. Add all regular contributions made for the year, including contributions made after the close of the year, but before the due date of your return together. Add this total to the total undistributed regular contributions made prior years. 3. Add all conversion and rollover contributions made during the year together. For purposes of the ordering rules, in the case of any conversion or rollover in which the conversion or rollover distribution is made in 2013 and the conversion or rollover contribution is made in 2014, treat the conversion or rollover contribution as contributed before any other conversion or rollover contributions made in 2014. Add any recharacterized contributions that end up in a Roth IRA to the appropriate contribution period for the year that the original contributions would have been taken into account if it had been made directly to the Roth IRA. Disregard any recharacterized contribution that ends up in an IRA other than a Roth IRA for the purpose of grouping, aggregating, the contributions and distributions. Also disregard any amount withdrawn to correct an excess contribution, including the earnings withdrawn for this purpose. Example. On October 15, 2009, Justin converted all $80,000 in his traditional IRA to his Roth IRA. His forms 8606 from prior years show that $20,000 of the amount converted is his basis. Justin includes $60,000 minus 20 in his gross income. On February 23, 2013, Justin made a regular contribution of $5,000 to a Roth IRA. On November 8, 2013, at age 60, Justin took a $7,000 distribution from his Roth IRA. First $5,000 of distribution was returned to Justin's regular contribution and is not includable in his income. The next $2,000 of the distribution is not includable in income because it was included previously. Figuring your recapture amount. If you had an early distribution from your Roth IRAs in 2013, you must allocate the early distribution by using the recapture amount allocation chart later. Amount to include on Form 5329, line 1. Include on line 1 of your 2013 Form 5329 the following 4 amounts from the recapture amount allocation chart that you filled out. The amount you allocated to line 220 of your 2013 Form 8606, the amount allocated to your 2009 through 2013 Forms 8606 line 18 and your 2010 Forms 8606 line 3, the amount allocated to your 2009, 2011, 2012, and 2013 Forms 1040 line 16B, Forms blah 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 on your other 1040, the amount from your 2013 Form 8606 line 25. Also, include any amount you allocated to line 20 of your 2013 Form 8606 on your 2013 Form 5329 line 2 and enter exception number 09. Example, Ishmael, age 32, opened a Roth IRA in 2000. He made the maximum contributions to it every year. In addition, he made the following transactions into his Roth IRA. In 2005, he converted $10,000 from his traditional IRA into his Roth IRA. He filled out a 2005 Form 8606 and attached it with his Form 2005 with his 2005 Form 1040. He entered $0 on line 17 of Form 8606 because he took a deduction for all the contributions to the traditional IRA. Therefore, he has no basis. He entered 10,000 on line 18 of Form 8606. In 2011, he rolled over the entire balance of his qualified retirement plan, 20,000, into a Roth IRA when he changed jobs. He used a 2011 Form 1040 to file his taxes. He entered 20,000 on line 16A of Form 1040 because that was the amount reported in Box 1 of his 2011 Form 1099-R. Box 5 and his 2011 Form 1099-R reported zeros since he did not make any after-tax contributions to the qualified retirement plan. He entered $20,000 to the qualified retirement plan. He entered $28,000 on line 16B of the Form 1040 since that is the taxable amount that was rolled over in 2011. The total balance of his Roth IRA as of January 1 of 2013 was $105,000, which is $50,000 in contributions from 2000 to 2012, plus $10,000 from a 2005 conversion, plus $20,000 from the 2011 rollover, plus $25,000 from earnings. He has not taken any early distribution from his Roth IRA before 2013. In 2013, he made a maximum contribution of $5,500 to his Roth IRA. In August of 2013, he took an $85,500 early distribution from his Roth IRA to use as a down payment on the purchase of his first home. See his filled out illustrated recapture amount allocation chart later to see how he allocated the amounts from the above transactions based on his allocation. He would enter $20,000 of his 2013 Form 5329 line 1. See amounts included in Form 5329 line 1 above. He should also report $10,000 on his 2013 Form 5329 line 2. And enter exception 09 since that amount is not subject to 10% additional tax on early distributions. And so you have an illustrated recapture amount allocation chart here on page 74 and 75. It's a pretty extensive worksheet. How do you figure the taxable part? Question mark. To figure the taxable part of a distribution that is not a qualified distribution, complete Form 86 is Part 3. Must you withdraw or use assets? You are not required to take distributions from your Roth IRA at any age. Minimum distribution rules that apply to traditional IRAs do not apply to Roth IRAs while the owner is alive. However, after the death of an Roth IRA owner, certain of the minimum distribution rules that apply to traditional IRAs also apply to Roth IRAs and explain later in distributions after owner's death. Minimum distributions. You cannot use your Roth IRA to satisfy minimum distribution requirements for your traditional IRA, nor can you use distributions from traditional IRAs to require distributions from Roth IRAs. See distributions to beneficiaries. Recognizing losses on investments. If you have a loss on your Roth IRA investment, you can recognize the loss on your income tax return, but only when all the amounts in all of your Roth IRA accounts have been distributed to you and the total distributions are less than your unrecovered basis. Therefore, never, for most people. Your basis is the total amount of contributions in your Roth IRAs. You claim the loss as a miscellaneous itemized deduction subject to a 2% of adjusted gross income limit that applies to certain miscellaneous itemized deductions on Schedule A, Form 1040. Any such losses are added back to taxable income for purposes of calculating the alternative minimum tax. Distributions after owner's death. If a Roth IRA owner dies, the minimum distribution rules that apply to traditional IRAs apply to Roth IRAs as though the Roth IRA owner died before his or her required beginning date. See, when can you withdraw or use assets in Chapter 1. Distributions to beneficiaries. Generally, the entire interest in the Roth IRA must be distributed at the end of the 5th year after the year of the owner's death unless the interest is payable to a designated beneficiary over the life or life expectancy of the designated beneficiary. See, when must you withdraw assets required minimum distributions in Chapter 1. If paid as an annuity, the entire interest must be payable over a period not greater than the designated beneficiary's life expectancy, and distributions must begin before the end of the calendar year following the year of death. Distributions from another Roth IRA cannot be substituted for these distributions unless the other Roth area was inherited by the same